Joining us right now is Anastasia Amoroso, who is Chief Investment Strategist at iCapital. And Anastasia, let's just talk this through. You think that there could be more room to run for the markets, but you're a little worried that it's getting stretched at the current moment. You want to explain what worries you, what you think the longer-term prospects are?
Yeah, good morning, Becky. I mean, we've had a torrid run over the last 6 weeks or so. You look at the S&P, it's up 8% in less than a month. And if you look at the NASDAQ, it's up 37% if you look at the NASDAQ 100. And Becky, I think what's driven this rally is a lot of people caught themselves not positioned long enough in stocks. And particularly if you look at hedge funds, for example, they were certainly not net long enough in April. And so they ratcheted up those longs to kind of the highest levels that we've seen in a year. And I think this happened to a lot of other investors as well. If you look at implied call option volatility, for example, it is at really low levels. So that tells you that investors have been chasing upside by buying calls. So that's what's driven this rally. And I think there's some fundamental catalysts as well. But I think we're sort of getting exhausted here. We're running out of steam, especially if you look at the technical indicators. So that's why I wouldn't be surprised to see some sort of a pullback. And by the way, this week, the Fed is back. The Fed officials are back talking about their policy. So that may spur some of the pullback. And we're also headed into the earnings blackout window. So corporates are not going to be able to buy the shares back. So I think that's a setup that is ripe for a near-term pullback. Having said that, you take a step back and you look at the Fed that's pausing. You look at the inflation that's clearly slowing. And if you look at the economy, as Steve pointed out, that is, maybe a little bit below potential, but it's certainly not cratering. You take all of that together, and that's what, to me, sets up still more room for the stock market to move higher. So if we get a dip, I suspect we will. I think that's a dip that is viable.
So you don't necessarily believe that the Fed is going to continue to raise rates either? You don't think it's necessary?
I think the Fed may continue to raise rates, another 1 or 2 rate hikes. I think the markets are actually pricing that in, and I think that's likely to be the case. But what I don't think it does is I don't think it derails the upside scenario for stocks. Because let's face it, the Fed is either done or they're very close to done. And we went from hiking at every single meeting by outsized, rate hike amounts to hiking, let's say it's 25 basis points a quarter. That's something the stocks can stomach, and they have historically, especially if the economic data continues to surprise to the upside. And that's really, really key. If you have the Fed that's hiking incrementally and the U.S. consumer is still supporting the economy, stocks can move higher. Case in point last week, Becky. I mean, you look at the move in the 2-year Treasury or the 10-year Treasury, the yields went up a lot. And yet you've got software, semiconductors, tech, and the S&P that all managed to rally. So that tells me that rate hike or not, another 2 rate hikes or not, I think stocks can still move ahead.